Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focusing on probably one of the most important developments that we've had over the past few weeks, and that is the breakout on the 10-year yield. We've been talking about this for quite some time. This has absolutely monstrous impact on the market. We're going to go through that. By the end of this video, you'll know exactly what impact this has on the short-term picture of the SP 500, what it means for risk assets in general, and why this signal that we're getting is going to give us some pretty great trading opportunities throughout the next few weeks. Now, if you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoyed this video, make sure to smash the like button. And now, without further ado, let's get right into it. All right, so I want to begin by quickly talking about the opinions that we've had on the 10-year yield. Now, this is a trading channel and we give out our convictions, we give out our calls. There are many channels out there that have no opinion, that make no calls. We see absolutely no value in doing that. We want to be very clear what our convictions are. And that means we're going to get some things wrong along the way. It means we're going to get some things right along the way. This is one big development that we got right. In fact, on our trading watch list on gameoftrades.net, we have a treasury bond short trade. So ever since the 21st of July, which was right here on this bottom, we've been betting for yields to rise and bond prices to fall. And our entire macro strategy, our entire positioning system has been based on this happening and seeing this breakout happen. Now let's first talk about the short-term consequences for that. When you have rapidly rising yields like we have right now, it's a sign of tightening. It means that lending rates are more elevated, so people take out less money, and it also means that saving rates are higher, so bonds become more attractive as long-term investments, and that drives capital out of sectors that are sensitive to that. For example, we can take a look at the tech sector, right? This is the tech sector divided by the SP 500. So the NASDAQ divided by the SP 500, and you can see what's been happening throughout the past few weeks. It's been going down violently. Why is that? Because yields have been rising. We can add the chart of yields on top of this, and you can see it's a very close inverse relationship. When you have yields go up violently, you have the tech sector correct. When you have yields come back down, you have the tech sector rise again, and so on and so forth. Again, yields rise, tech corrects, and here we've had yields rise and tech correcting. So that's the first thing that yields can do. It can put pressure on the tech sector, and we know that tech has been a big outperformer since the end of the dot-com bust. So seeing this type of correction on the tech sector can put pressure on the rest of the market. So those are the short-term consequences, and that's why if we continue to see yields rise in the next few days, next few trading sessions, it could continue to put a little bit of pressure on the stock market and continue this correction that we've been seeing. So those are the short-term consequences. It goes a little bit into detail, but short-term, it can create a little bit of a panic move from investors as they rebalance their portfolio. Now, what about the intermediate term consequences? And for this, I want to take a look at a chart that speaks a little bit more, and that is TLT. This is a chart of treasury bond prices. This is the main treasury bond ETF, and it's a perfect inverse chart of yields, right? When yields go up, bond prices go down. You can see, in fact, throughout the past few weeks, as we've had yields go up, we've had bond prices come down, break down here. And typically, TLT serves as a big warning signal of risk. And I'm going to show you that in a couple of different ways. First of all, look at 2007 here. TLT was rising way before the great financial crisis. And this was investors positioning into the bond market ahead of a big risk-off event that eventually happened in 2008, right? So you can see on this chart, before we get any significant downside on the market, you already have TLT rising significantly. So that was a major warning signal in 2007 that the market environment was switching from risk on, where bond prices were falling and stock prices were rising, to risk off, where all of a sudden treasury bond prices were rallying. And you can see, we can do a little bit of a technical analysis on this chart. You can see the exact moment where bonds broke out, where TLT broke out, was the exact moment that the SP 500 topped. So you could have timed that. You could have used this breakout on TLT as a warning signal that the markets were going to switch to risk off. But now look at what's happening. Do we have this type of signal? Absolutely not. We've had TLT tank down here and actually break down significant levels of support. If I show you a daily chart, we can take a look at that in detail. These were the big technical levels we were looking at on TLT. This was the downtrend line connecting these two major highs on TLT. And right after the Omicron announcement that we had on the 24th of November, we had a breakout of this downwards price channel. And look at what happened recently, break back under. This is a textbook false breakout, and this is a bearish development. This is not good. If I was a treasury bond bull, I would have liked to see a nice resumption and not this type of breakdown. The other levels we were looking at was this uptrend line right here. Nice reactions. That was broken very impulsively. And also this minor uptrend line here, also broken very impulsively. So just from a technical analysis standpoint, now of course we don't just pay attention to the technicals. We love to look at the macro monetary policy, market cycles, intermarket analysis. But if I'm just looking at the technicals here, this looks like a major leg down, a period of consolidation, and a resumption of the downtrend. So if we get this type of move, we can very well see a move down to the bottom of this long-term price channel that we've had, down to around $120 to $125. So that's a big move down on TLT. And by then, bonds will be unbelievably attractive relative to stocks. And that's very likely to be the top of the stock market cycle. But until then, this is a bullish development. And it means investors are increasing their risk, not reducing their risk. So that's bullish for stocks. It's bullish for Bitcoin. It's bullish for risk assets. In fact, we can take it one step further and divide TLT by J and K, right? So that gives you the ratio between treasury bonds, which is high quality bonds that are very unlikely to default, and J and K, which are junk bonds, so often considered low quality bonds. And so that gives you essentially the credit spread. And you can see you often have the credit spread rise in anticipation of big risk off events in the market. So you have TLT begin to rise and J and K begin to fall. That's an early warning signal that you have a rising risk in the market. And, just quickly looking at this, we had a few of those signals throughout the past decade, and all of them were before major risk-off events. Now, in 2014, it wasn't a risk-off event, but it told you that bonds were a lot more attractive. But now look at what's happening. We've just broken down below this small uptrend that we had, and a lot of people were calling for this to be the beginning of a major risk-off move. We were not in that camp because growth and inflation were so strong here. And the rallies that we saw in TLT were primarily due to the Delta variant that we had between April and July 2021, and then the Omicron variant that caused one last move up. And now I believe that's over. I believe those fears are done, and the bond market is going to price in the growth and inflation we've had and fall. Now, I have one more thing to show you on this chart that I find absolutely fascinating, and that's where technicals can be such a powerful tool to time the markets and time the macro. If we add a trend line on this chart, this is a log scale chart of TLT divided by J and K, and we take a look at all the reactions on this trend line. You can see one in 2008, one in 2011, one in 2013, one in 2018. That gives us a very nice next target for TLT divided by J and K at around 1.24 here, also coinciding with some pretty strong level of support. So if we see the ratio begin to move down into this range here throughout the next few weeks, we'll be strongly considering beginning to switch from a risk-on portfolio and risk-on trades and risk-on watch list to risk off. But until then, once we're done with the S&P 500 correction that we're currently seeing, maybe come down to a little bit lower levels and retest this long-term trendline support as we've been talking about throughout the past few videos. Once that's done, I think the S&P 500 is going to begin pricing in that movement out of risk that we're seeing on the bond market, out of treasuries and into risk assets. And for those of you who watch our Bitcoin videos as well, that same theory applies to Bitcoin. Once we get that little Federal Reserve tightening scare out of the way throughout the next few weeks, it might create a little bit more volatility until then. But once that's out of the way, it's going to create some massive buying opportunities for risk on assets. Of course, that is our opinion. A lot of people do not agree with that. Please do make your own research before trading and investing. Now, in the meantime, I wish you good luck on your trading and see you next time.